Howdy, Jacob here. Today we're looking at Corporacion America Airports, ticker symbol CAAP. It is in the transportation infrastructure industry. They acquire, develop, and operate airport concessions. They operate in 52 airports in Latin America, Europe, and Eurasia. Founded in 1998, based out of Luxembourg. Growth is not terribly impressive. They were hit very heavily by COVID, but are getting back almost to the same revenue as pre-COVID levels. However, they have been increasing their margins enough to where they have higher operating profit than they did pre-COVID. And that's making their return on invested capital, at least in the most recent year, look very solid. Whether they can keep this up or not is something you're definitely going to have to do more research in to see whether you believe that's the case or not. It's very interesting to me how close the last 2 years of gross margin were and operating margin. It's almost like cost of goods sold is really by far their heaviest driver here. Um, Sales, general, and admin really not a huge cost. Uh, all right, interesting. Shares pretty much flat the last couple of years. Balance sheet has about $450 million cash on hand with 200 million short-term debt, 1.1 billion long-term debt. They do have a bit of net debt here. Cash flow statement. Cash from operations is massive. Very little capex. It doesn't take a lot to keep the business rolling. Use of cash, I guess reinvestment, a little bit of acquisition. They haven't really bought back any share. Haven't really bought back many shares. Debt, going up and down. So you don't really get to see exactly what they do with their capital allocation. So that's not the best. You do want to see companies reinvesting if they get great returns or giving it to you somehow. So um, that'll just have to be in our assumptions. So let's start with revenue growth. I think it's kind of all over the place right here, so I don't really know where to go. Maybe 5%, and then I guess market average. And then for margins, it's been a lot higher recently. I'm going to do a pretty big range, saying I'm not really exactly sure what's going to happen. Share change relatively flat. Stock-based compensation's extremely small, so I think flat is fine. So, I mean, yeah, this is saying, same capital allocation as before. They don't really increase too much shares through stock-based compensation, so they don't really need to buy back anything. They don't pay a dividend. So this is just, can you keep the margins of today? Then it might be a decent buy. But for me, I'm going to lean on the conservative end and say that it falls down to maybe more historical averages outside of the crazy COVID levels. And so I'm saying it needs to fall 53% to get to the return I'm looking for here. I'm just going to be waiting for it to get to a more attractive price. Hopefully you enjoy the new year. Have a great rest of your day. Thank you.